Well, as we wind down this turbulent year in the markets, our next guest emphasizes downside risk in 2023, driven by significant looming risks, including another hit to corporate profits, stickier inflation, and of course, issues with the Fed's pivot. Let's bring in Dana Dioria, Investment PMC Co-Chief Investment Officer. Good to see you. So as we look at some of these downside risks, obviously some were black swan events we couldn't predict, like Russia's invasion of Ukraine. But what is going to carry over into 2023?
Hi, thanks so much for having me. Yes, I think unfortunately a fair amount of what we're looking at right now is on the tap for next year as well. Certainly for the first half of the year, we've encountered a period of time where the market seems intent on expectations of a Fed pivot. I think we're finally getting to the point where the market is a little bit more wary and cautious around that. My expectation, just looking at the information, is that maybe second half of the year, but I think the Fed has been pretty clear. They've been very consistent about the fact that they don't want to have stop and go policy. We've seen, in the past that does not work well. The employment market remains strong. Another jobless report coming in, just confirming this. Wages remain sticky. It's the piece of inflation that's really kind of really staying high and sticky. So I do think that, the risk that we've had the second half of this year continue on into the first half of next year for sure. Top of the list. We have to continue to fight inflation, even as a lot of it is peaking, and the Fed will continue to do that.
And we have seen investors at some points getting a bit ahead of themselves with every sort of data point that comes out. But you say it's possible that the Fed pivot doesn't materialize in the way that the market expects. How so?
Well, I think, I think the market has been expecting maybe terminal rate lower than 5, maybe even January, we're not seeing an increase. And I just don't think that that's going to be the case. I do think that we continue to see increases, January meeting expectation of an increase there. And also that even if we remain flat, we're not actually easing. And I think to a certain extent for a while there, the market was sort of expecting that, just kind of a turnaround and that the rate is coming back down pretty quickly in the course of 2023. I think, again, I just don't see that happening in the near future. We do know that, historically wages, jobless claims, right? This kind of stuff can get hit more towards the end. So the fact that jobs unemployment is still low now is not so surprising, right? We would expect maybe 12, 18 months in to start to see the pain from the unemployment and, more of the recessionary conditions that we would associate outside the market happening. But that does mean that the Fed is empowered to continue kind of taking the stance it's been taking, at least as we move into the early part of 2023.
And digging into the labor market, you say that the bad news is actually good news for the stock market, but for the time being. At what point does it start becoming bad news for the markets?
Yeah, it's a great question. I mean, it's good news, obviously, in the sense nobody wants to see unemployment. But from the market's perspective, you have to see some weakening in the employment picture because we have to see wages, the stickiness of inflation in wages start to ease up because we know that's what the Fed is focused on. So the market is kind of waiting for a report that sort of says, OK, we're peaking there, too, in terms of wage increases. We're maybe getting on the other side of that. And that in turn would obviously potentially lead the Fed to say, OK, now it's time to start easing on increases, maybe even pivoting the other way. So that's the reason that's the sort of thinking that we have here. I will say, right, there's a lot of other indicators of weakness that we're starting to see and, probably will see as we head into 2023. Corporate profits probably need to come down a lot. You're still seeing, obviously, inverted yield curve. You're seeing issues in Russia and Ukraine. I mean, we're going to be going on a year, and I don't think anybody thought that this was going to last as long as it has. China still working through the segment you just had, right? Great information around just, China working through its policies. So there's a lot of issues that kind of loom for the market in general, for the economy in general. The labor is just kind of this holdout, but the Fed's mandate is inflation and unemployment. So those are the two things they really focus on.
So then, as we mentioned, all those factors that you just laid out there, what does that mean in terms of asset allocation? What do you do for your portfolio when you have so much uncertainty?
Well, the standard advice, of course, is you have a good mix of equity and fixed income. I think everybody really got a startling surprise this year when the 60-40 kind of failed in that respect. We saw double-digit drawdowns both on the equity and the fixed income side. And of course, that's because you had these really sharp run-up in interest rates that killed, fixed income. Of course, for the most part, we're past that huge run up, right? So now we're looking more at priced in increases, maybe staying higher for longer than we'd like. But in terms of actual losses in fixed income, I think, the general consensus is we should start to think about moving back into fixed income, even though clients are maybe, have a little bit of trepidation around that. So number one on asset allocation is, the fundamental advice of being at the right equity to fixed income ratio in terms of what your risk tolerance can handle is still very much applicable here in spite of what we felt in fixed income markets. And then I would say on the equities, you're looking probably at defensive stocks, at least for the time being, if you're trying to react to what's going to happen in the short term. So if you're trying to say, I want to feel safer in the holding and the asset allocation that I have, you're looking at quality stocks, you're looking at low volatility stocks. I would say, though, if you're in the market for the long haul, as hopefully most clients are, then, small caps, obviously being international, what markets are cyclical, right? So what's worked in the last 10 years, oftentimes the next 10 years is different. We've just had a period of time where US stocks have outperformed dramatically. So there should be an expectation that, things can swing over to the international markets just based too on valuations. But that might not be as a defensive, comfortable place for clients to be. So if they can stomach that and be, kind of have that longer term view, it's probably a good opportunity to diversify into those areas. So it really depends. Am I looking at this on a short term or a longer term basis?
So there you go. Check your time horizon and your risk tolerance. A big thank you to Dana Dioria, Envestnet PMC Co-Chief Investment Officer. Thank you for joining me this morning.